broadcast. We are live now, right? Oh my, I forgot it. Okay, I'll just start again. Uh, from the beginning. Welcome guys, welcome everyone. Thanks for joining us. Can you guys hear me or what? Yes, Titus, you can hear me? Okay, cool. Yeah, so I was already talking for 5 minutes and then I realized that I forgot to press the broadcast button. Apologies, guys. So let's just get started straight away. Uh, Welcome everyone to the How to Analyze Stocks the Fast Way webinar. And yeah, I want to thank Titus from Stockbroker Game to give me the opportunity to talk to you guys. Um, and yeah, I'll quickly introduce myself and then we'll move on. Okay, cool. You can hear me. That's perfect. Okay, so my name is Nick Kraakman. I am the founder of valuespreadsheet.com, and I'm very excited to be here with you today. And why are we here today? Well, because I want to show you how you can analyze stocks in a quick way, in a very fast way, and also show you how to calculate the intrinsic value of a company, the real value of a company. I will also allow you guys to shout out some stocks, and I will analyze them for you on the spot. I am from Amsterdam, a beautiful city in the Netherlands, and no, I do not smoke weed. English is not my native language though, so apologies in advance if I happen to ruin some grammar. And I really would like to make this webinar a bit interactive so I can tailor the content to what you guys want to know instead of just me talking to you guys. I would really it would be really cool if you guys would ask questions and I could tailor the content to what you guys really want to know about investing in general or the stock market or whatever. And I'll try to teach you as much as I possibly can. I'll try to keep it within an hour. And after that, I'll show you how you can get more help if you wish. And you will also receive a copy of my ebook, How to Value Stocks, at the end of the webinar. So please remind me to share the link with you guys. And there will be plenty of room for questions during and after the webinar. But for now, let's just continue and get started. Okay. So as most of you guys will know, this is Warren Buffett, the world's greatest investor of all time and the third richest man in the world. And he once said that whether we are talking about socks or stocks, I like buying quality merchandise when it's marked down. And this quote really captures the essence of his strategy, which is buying great quality companies, high quality companies, and buying them when they are trading at a very cheap price relative to what they are actually worth. And this strategy is called value investing. And I will tell you a bit more about that in the coming minutes. And yeah, I hope it's of interest to you guys. So what I've been doing, I've been studying the strategies of Warren Buffett, but also his mentor Benjamin Graham and other great investors like Monish Pabrai, Philip Fisher, and John Templeton, and many other legendary investors. I've been studying their strategy for years now. And even though the details of their strategies differ, they all base their decisions on the following two key questions. The first one is, how well is the business performing? So that's the quality aspect. So how is it a high quality business or not? The second question they ask, how much is the business worth? Because only if you know what a business is worth, should be worth, based on a thorough fundamental analysis, you can decide whether it's cheap or not. Because it can only be cheap, the price can only be cheap relative to what it should be worth, and not cheap relative to the price of yesterday. But we'll go into more details later on. So this is the value investing that all these great investors that I just mentioned employ. And it's all based on finding the answers to these two key questions. And when I first learned about this strategy many years ago, I understood that this systematic approach could be made a bit easier by using Excel spreadsheets. And at one point I was using about 9 different spreadsheets to analyze stocks, and it took me several hours to retrieve and fill in all the financial data needed to analyze one stock. And this was not only boring and time consuming, but it was also it led to mistakes, because when filling in all this financial data, if you put one comma in the wrong place, your calculations get messed up. And therefore, I started to look for ways to solve these issues. And the first thing I did was merge all these spreadsheets together into just one. So I no longer had to fill in the same data several times. But then I realized how amazing it would be if I could draw in all the required financial statement data into the spreadsheet automatically. And after several sleepless nights of programming, I finally succeeded. And the result was the very first version, of Value Spreadsheet, and which is a tool which allowed me to analyze stocks in seconds instead of hours, thanks to this automatic data retrieval and then several smart calculations that I built in. And the thing was, I created this tool for myself, okay, for my own investments. I never had the idea to sort of make it public or whatever. And I successfully used this tool, this spreadsheet, for several years for my own investments. And then I decided that maybe other people can benefit from a tool like this as well. And we are now several versions later. And yeah, Value Spreadsheet has really evolved into a powerful investing tool that anyone can use on any device with an internet connection, because it is powered by Google Documents. And Google Documents works on every device. They have apps for Android, for iPads, and you can use it on your phone, you can use it on your laptop. It's really a very flexible platform, while regular Excel spreadsheets only work on Windows. And I would now like to show you this premium value spreadsheet and how it helps me to analyze stocks in seconds, literally seconds. And I will first run you through the most important features quickly, and then you guys can just give me some stock tickers, and I'll quickly analyze them for you on the spot and tell you what I think of the stock based on the calculations from the spreadsheet. So let me show you what this tool looks like. Here it is. This is the spreadsheet I was telling you about. And what you see here is the dashboard page. Here in the bottom you can see that there are several tabs. Actually, there are quite a lot. I will quickly go through them. But this is the most important page of all. Remember the two questions that the greatest investors try to answer, like how well is the company performing? And that's sort of summarized in this score figure here on the left. That's the answer to the first question. And this score is based on all these factors that are listed down here. So the spreadsheet draws in several years of financial statement data. I can show it here in the Statements tab. As you see, it gets 4 years of financial statement data, income statement, balance sheet, cash flow statement, and it runs several checks. It analyzes this data for you, because there are many investment tools available online, and what most of them do is you fill in a ticker symbol and it returns you a lot of data. But the value spreadsheet takes it one step further and analyzes the data for you, and also gives you a judgment based on that analysis. This is the Analysis tab. What you see here is that it checks several important metrics, at least metrics that are important for value investors, because this tool is really aimed at value investors primarily. So with that I mean investors who are looking for great companies, high quality, highly profitable companies, which are trading at discount prices, which is, I guess, the best way to earn money on the stock market in the long run. So for example, it checks the return on equity. But it also gives you an explanation of it. It says, okay, this return on equity value is good, and it also tells you why it is good. So even people who don't have that much experience yet can really learn from this. Because, for example, it says the return on equity is good. It is consistently high, so it also checks how high it has been in the last couple of years. And this means that the company is able to invest its capital profitably, which is a good sign. Hence the good. And it checks all these things. The debt to equity ratio, for example, very important. It shows how much debt a company has in relation to capital or equity. If a company has a lot of debt in relationship to its equity, this wouldn't be good. This would be bad, because then the firm, now it says it's good because the firm is not dependent on loans and therefore has a low interest rate risk, which is a good thing. You don't want an interest rate fluctuation which you can't control uh, be able to destroy a company because it has so much debt. Um, so that's the first thing you see here on the dashboard page. You also see these points, and that is based on the weight you assign it. And this might sound a bit complicated, but it really isn't, because as I said, I developed this tool initially for my own investment strategy. However, everyone uh, everyone has his own little strategy. Everyone thinks, oh, this is more important than this. Return on equity is more important than the net margin or whatever, you know. This system allows you to very easily tweak. For example, if you do think that the return on equity is, or the debt to equity, for example, is not important at all, you could assign it a value of 0. And as you see, it changes the score. This way, you can really tweak the rating to your own to your own strategy. For example, if a growth rate is very important for you, you can give it a higher value. Let's say 8. And again, you see what happens is it assigns more a bigger weight, a bigger importance to the growth rate, but the growth rate is relatively low, and therefore it drags the score down. And which is what you would expect. So this is a really highly customizable system. So with whatever strategy you're following, um, as long as you're looking at fundamental data, this spreadsheet could really work for you. Another really cool thing is based on the data that we're drawing in, and here's another a tab which shows some of the data that is coming in, like the price, earnings per share, dividend yield, growth rates, things like that. But here you also see we have 4 years of financial statements, but we have 10 years of several other ratios, which is really useful because we could, for example, look at the book value per share, and we see that for the current company Bed Bath & Beyond, we see that it's growing at a steady pace, which is a very good sign. And these 10 years of data are then plotted in a graph. So you can have a visual overview of how the company is performing. As you can see here, it's all plotted. You see that the profit margin is sort of fluctuating between the 10 and the 6%. Same for return, but you see book value is nice and increasing. So this gives you a nice overview of how the company is performing in a glance. It's very quick. So what would happen, for example, if we would input another ticker symbol? Because this is really the only thing you have to do to analyze a company with this spreadsheet is to fill in a symbol. So for example, let's look at the often discussed Apple. See what it gives us. As you can see, it's loading the data now, and now it has loaded all the data. It's pretty quick. It's like 5 seconds, and it gives you another overview. But let's, for example, look at the valuation, which is very interesting to look at as well, because we covered the score part. Here on the right, we have intrinsic value estimates. The intrinsic value, what it is based on profit, on like the amount of net income that a company is generating or the amount of cash a company is generating. There are several models to sort of calculate what realistically a company should be worth based on the amount of money they are generating. And because all of these models have some sort of assumptions that they make, none of them is 100% perfect. So there is no perfect way to calculate the value of a company, of a stock. Therefore, I've used 3 separate models and then take the average. sort of, the one model goes a bit higher, the other one goes a bit lower, and this sort of evens out if you take several models at once. Just remove this. The thing is, if you disagree, for example, one could be much higher than the other. I created all these override fields, which is very useful because this is all automatic calculations, right? So you have these three valuation models. They come up with these values, and this is the average. Now, if you don't agree, if you think, no, it's probably closer to the $125, you could input that here in the override field, and the spreadsheet uses that value instead. Now you see that based on the current share price of $102.40 and a value of $125, it's currently 22% undervalued, which is nice to know. It means that you could buy Apple and have about a 22% upside from today's price. And here beneath, this is very interesting. At least I think this is one of the most powerful things. It gives you a max purchase price. What does this mean? Well, everyone has an investment strategy, and everyone has some sort of figure in their head, like I want to earn at least a 10%, 15%, 20% return on my investments. Whatever it is, you can input that on the inputs tab. I said desired return on investment 25%. I thought let's put it high. Okay, let's lower it to let's say 15% annually. What happens now is if you go back to the dashboard, you see that it gives you the max purchase price of $95. What this means is that based on the value you calculated, and based on today's price, or no, sorry, based on the value you calculated and based on the return you want, you shouldn't buy above the price of $95. If you buy below this price, you have a good chance of earning 15% a year. This is a very interesting fact to know, and as you see, it's very fast to calculate it. For example, let's do another one, Dolby. See, it gives you another, and you see that this scores a lot lower. And the great thing is that normally when you analyze a company, you go, even if you have some sort of a checklist, you have to go through every single item on the list to see, like, okay, is it how profitable is it? How much debt does the company have? Things like that. How much cash flow is it generating? This spreadsheet does it automatically for you, and it highlights the items that require some more attention. Because if it says return on equity is bad, you should have a look at, okay, why is it considered bad? So let's take a look at the graph and see what's happening there. We see return on equity is decreasing, and it's actually not, the thing is, it's actually not that bad. The reason the spreadsheet says it's bad is because it also looks for consistency. And as you can see, it's fluctuating quite a lot. That's why it highlights that it, so if it says bad, it means take a closer look. And this really focuses your, while analyzing stocks, it really focuses your attention towards the point that might need some extra attention. And while you could skip all the ones that say good, because you can assume, like, okay, the return on debt to equity is good, so I don't have to waste any time on that. This really speeds up the analysis process. So I just wanted to show you the different models that we're using to calculate the value. The PE valuation model, it uses the price to earn, or the earnings per share figure, and uses the expected growth rate, takes some sort of a safety margin of safety, to come up with a more conservative estimate, because of course making predictions about the future is almost impossible, and therefore you shouldn't take the most optimistic expectations into account, but take a conservative growth rate instead. So this is the 10% that analysts believe the company will grow in the coming 5 years for each year. So I just take 25% off and use the 7.5% figure instead. And you predict it into the future and multiply it by the median historical price earnings ratio. So you just look at the last 10 years, which is the data we get on the input step. We see the price earnings ratio in the last 10 years, in this case 9 because it's not available for 2004. And you take the median and you discount it back to present value to come up with this value of 37. Again, you see these override fields. If you think that the data is incorrect, you can fill in a different figure and it will use that figure instead. The discounted cash flow model, which is a very it's an often used valuation model in finance. It uses the so-called free cash flow, and again, sort of predicts it into the future and then discounts it back to today's value. And for the people who don't know what discounting is, it's actually pretty simple. I mean, it's based on the concept that $1 today is worth more than $1 tomorrow. Because if you have $1 today, you can invest it today and earn an interest on it. So if you have $1 today and you earn a 10% interest on it, it will be worth $1.10 tomorrow. So it's $1 today is worth more than $1 tomorrow. That's the idea. So that's what this system is based on. It applies the growth rate, but then it applies this discount rate to calculate the value of that future money today. It might sound a bit complicated, but you should definitely look it up, discounting, because it's a often used tactic in finance. As you can see, it's a discounted cash flow valuation model, but there's also a so-called reverse discounted cash flow built into the spreadsheet, which shows you, based on the current figures and the current share price, what growth rate is priced into the current stock price. So if you look at the current stock price of Apple and you compare it to the value, or in this case we're looking at Dolby, of course, you see that there's an 11% growth rate priced into the stock price. If you think that that's a bit too high, then this could be an indication that Dolby is currently a bit overvalued and not the cheap stock you're looking for. Finally, we have the return on equity valuation model. I won't go into detail. As I said, you will receive the How to Value Stocks ebook from me at the end of the webinar, and it explains all these valuation models in detail, including examples and where you can get all the data. So even if you decide not to do anything with this spreadsheet, you can create your own Excel valuation models and then fill in the data manually. And finally, the final tab here is financial health, which is also very interesting because this is based on a book which is called It's Earnings That Count, written by Hewitt Heiserman, who is a very, very knowledgeable financial expert, and he sort of analyzed the big financial scandals of the last century. So, for example, the classic example of Enron, the company reported growing earnings, but still it went bankrupt in a massive way. So he figured out a system to sort of tell in advance which companies would go bankrupt. And the system is fairly simple, actually, because he figured out that if companies report increased net earnings, which he called accrual profit, which might be a bit confusing, but just think about this as net earnings. I'll just change this for you. As you can see, every single field in this spreadsheet is editable. You can also edit the formulas even if you want. That's the beauty of having a spreadsheet instead of an online tool, because many of these online tools, they just give you yeah, the calculations as they are, and there's nothing you can change about them. And here you can literally tweak every single thing, every single detail of the spreadsheet. So, but to go back, and he called free cash flow, he called it defensive profits, but I'll change it for you as well, just because it's easier to understand. So he said that companies like Enron, who are yeah, misrepresenting their earnings, he saw that they were reporting increasing net earnings while they were showing decreasing free cash flows. So in the analysis, the stock spreadsheet, the value spreadsheet, takes that into account. So if it notices that the company is doing this, it gives you a red flag. It says, take a look at that, be careful, because this company might be manipulating its earnings, which is, of course, a very powerful thing to have in your take into account in your analyses. Also, the Altman Z score, which is a widely used metric, which is able to sort of, at least it was invented by a scientist. His last name was Altman, obviously, and he created this Z score to sort of predict if it was below certain threshold. So if it was below 1.8, there was a significant probability that the company would go bankrupt in the coming few years. So that's why I included it as well, also in this financial health tab, just to have another check to see if this company is financially healthy, if this is a quality business, or if it's a company that is about to go bankrupt. So yeah, you've seen all the basic functionality now. If you want to shout out some ticker symbols, it would be great. I can analyze them for you on the spot. Otherwise, I will just input some tickers myself and show you my opinion of these stocks. Let's see. I'll just one RSH. Let's see. Spreadsheet. Radio Shack. Interesting one. Yeah, that's what I figured. Radio Shack isn't doing too well, which is shown in the score, just 35. So let's see what's going on. So remember, this is all based on financial figures, right? So this is not looking at will Radio Shack be a turnaround story or things like that. No, it just looks at the financial figures. How is it doing? And as you can see, its profit margin is just sinking. It's in the negative 12%. Obviously, it's making a huge loss at the moment, and this is really, really worrisome. Both of these charts, by the way, because you see that the debt to equity ratio is just increasing like crazy. So a 3.0 debt to equity ratio means that Radio Shack has 3 times more debt than it has capital, and that's very worrying. And if you look at book value per share, Warren Buffett once said that if you look at the book value per share growth, it sort of shows you if a company is creating value. Because if a company is consistently generating excess cash, its book value will steadily increase. So that's the kind of company you want to be looking for. As you can see, Radio Shack is just it's going down the drain. I would stay far, far away from this stock unless you want to short it or something. And as you can see, the valuation models can't really do anything with this company either, because if you have a very unpredictable company, which makes a profit one year and it makes a loss the other, there's no way that you can predict what it will do next year. You know, so only companies with stable earnings are you're only able to really sort of determine a value for a company with stable earnings. For example, let's take a look at. Oops, I'm just messing up now. Take a look at Google. I like Google a lot. I used to own it. I do not own it anymore because I thought it was a bit expensive. And as you can see, yeah, so the value is probably more around 500. Even then, even around 500, the the current share price is 582. So Google is not cheap at the moment. It's a good company, although their net margin is also shrinking. But I sold them because they were too expensive for me. So I see Siri. Let's see Siri. Sirius XM, I believe. Yes. Okay, I don't even think there's enough data to analyze this one. No. What is it? Okay, let's try another one. From my head. There's an interesting one. Amazon. Amazon it's a strange company. They sell so many books and they're still not really making any profit. It's pretty terrible. As you can see, it doesn't score too well. Let's take a look at the graphs. Book value is increasing though, which is okay, but the book value is at 20 and their stock price is above 100. Um, Net profit margin here, it's just so incredibly low. It's such so weird. I mean, they're so huge and still not really turning any profit whatsoever. I'm wondering when that will ever happen. As you can see, the valuations fluctuate wildly. That is because, as I said, it's hard to predict the value of a company that is very unpredictable, has a very unpredictable business nature. Okay, let's see JC Penney. I think that's a financial company, right? And financial companies aren't really easy. Oh, department stores, of course. Woo! You're not giving me two great companies titles. They're all just making a loss. They're just losing money on all sides. Look at this. Why you do not want to own companies like this. They're not creating value. Okay, let's see. Let's have a good one. One I particularly like. It's a very it's a small company, and they're having a very interesting product. They're selling female condoms, and the cool thing is that um, they have very volatile earnings. They have a couple of huge clients because their clients are governments of third world countries, and these guys, these governments, they sometimes purchase thousands or millions of their product in one go, and then they won't buy for another year. So their earnings they really fluctuate, and investors seem to miss this point. They think that they reported lower earnings, so the stock price plummets. But in fact, their order book is filled, and as you can see from the let's look at this one. Look at the return on equity. It went from minus 138 in 2004 up to here. It's 50. If you look at the last couple of years, it's on average 50% return on equity, which is really, really good. They are highly profitable, and as you can see, their net margin is just increasing. 45% net profit margin, which is amazing. Their book value is increasing. They have no debt, zero. This is a great company, and it's completely undervalued. Let's see, I'll do one more. SGOC. Okay, let's have a look why it's showing. Yeah, it's showing a negative discounted cash flow, and that's probably because it had a negative cash flow. Let's look at this one. It had very low. Here it had negative cash flow in 3 of these years, and now it has tiny positive free cash flow in the last year, but probably has a lot of debt. Yeah, they do have some debt. And they had this is the trailing 12-month free cash flow, and it was negative. That's why it ends up with negative value. Yeah, so again, I wouldn't really be interested in a company like this. It's dangerous. I mean, let's see what their profits are doing. If they are making a profit, the margin declining. 4% is not a high profit margin in many industries. They do have very little debt, which is good. Book value per share. This might be, as you can see, it's sort of in a turnaround phase, so this might be worth looking into a bit further. Interesting. Okay, so let me go back to the presentation. Let me see. There we are. Yeah, so I just showed you this the value spreadsheet premium and what you can do with it. The regular price for this tool is, if it all, yeah, the regular price was $297 a year. So it was a subscription basis, but because with Titus we made a special deal for the stockbroker game players, which is you. Now the price is not $297 a year, but a special offer of $197 for lifetime access. So it's a one-off payment, and you get access to all future updates. You get access to the fully functioning spreadsheet. You can like tweak every single cell in the spreadsheet to your own liking, and you'll get free updates. And I will always you can always contact me directly. I'll answer all your questions within a day. And you can take advantage of this offer by going to valuespreadsheet.com/broker. And I also show it here on the side. But the offer is only valid for 27 hours, so don't miss out. I will send you, like I said, a replay link tomorrow. You can watch the the webinar again if you wish at your own convenience, or send me an email at nick@valuespreadsheet.com, and I'll try to answer all your questions. Yeah, so take use of this this unique offer, because it's $100 off, and also it's just a one-off payment, and this is a very unique offer. I don't do this often. It's just because Titus contacted me, and he said, I want to do something special for my for the players of my stockbroker game, and this is what we came up with. So thank you guys for listening. I promised you guys to give you my ebook, so I won't forget that. I'll put the message in the chat right now with a link. You can download the ebook right there through that link, and yeah, you can have a read there. You can read the details of all the valuation models that I showed you, and how you can apply them to your own investment strategy, and use them to calculate the value of any company. And I really hope you you enjoy the information in the ebook. And yeah, remember, this offer is valid for 72 hours only. So if you have any questions, you can ask them now, or send me an email later. And yeah, I would like to thank you for your attention otherwise. You get the link to the ebook in the email tomorrow as well. So yeah, if you missed this one, in the underneath the replay link, you'll see this link as well, and you can download the ebook there. What's my favorite stock right now? It's difficult, Titus, because the stock market is in general is a bit overvalued at the moment, and so it's not that easy to find really cheap bargains. There are great companies out there, and so what I do in a situation like this, I just find all the greatest or all kinds of great companies with solid financial track records. So with high profitability, low debt, and I put them on my watch list. And I just wait for a correction, and that's when I buy. I wait until the price is good enough, because in the end, you make the money when you buy and not when you sell. If your purchase price is too high, there's nothing you can do about it, and you're sort of missing out on a lot of upside. So I'll just try to answer the first question, the first key question of investing: how well is a business performing? And when I just create a list of companies which are performing really, really well, but are currently a bit overvalued, and then I wait until the price becomes better, and I dive in. So I got quite a lot of my money in cash at the moment. Um, yeah, that's because, as I said, there aren't too many great opportunities. I do really, really like Apple. I've been in Apple since it was at $450, and now it went through a stock split, etc. But yeah, I'm still holding on because, as you could see, I've shown Apple in the spreadsheet as well, and I believe the value is much higher still than it's trading at the moment. I believe Apple is worth at least $140 a share. So yeah, I'm waiting for that to materialize before I start selling. And also the female health company, FHCO, that I showed at the end. It's a really, really great company, and I mean, it's a bit of a risky one as well because it's such a small company. It's a micro cap, and still I sort of believe in the company. I mean, it has such solid financials, and they recently cut their dividend. They had a really nice dividend, but the thing is, people overreacted to that, and they thought, oh, I want out. So they started selling the company, and so pushed the price down even lower. Uh, but if I mean, it's not a bad move because they want to use that cash that they don't have to pay out as a dividend, so they keep a lot of extra cash. They want to use that cash to create new business opportunities, grow their existing business, and do extra marketing and sales. So I really believe that this can be a move to grow the company, and so it allowed me to buy the company at an even lower price because people just overreacted to the news. Okay, guys, so if you don't have any questions, thanks a lot for your attention, and yeah, I'll talk to you next time.